So as we've heard from Qian, who took us on a tour of the global economy, we're going to be in store for a more challenging environment. She's described the environment as being frustratingly fragile and economies transitioning towards an environment of lower growth and ultimately likely somewhat lower returns for investors down the road. And this outlook is the result of a very serious analysis and sound judgment that has been hard-earned through years of training and experience. In contrast to that, we can expect that many of our investors, though, and many of your clients and our clients are going to have probably a bit more of an emotional reaction to the events that have been occurring. They're going to react to words like bearish and words like bear market and words like volatility and recession and correction. And in some cases, these are all words that accurately represent the state of markets and the challenges that we all face today. But they're also definitely words that many of our investors will take out of context, and sometimes that will lead them to make short-term decisions with their portfolios or adjustments with their portfolios that can have very serious and damaging long-term consequences for their ability to reach their longer-term goals, whatever it may be. But it's very difficult to blame them for having this sort of emotional reaction to the events in the markets because they've been challenged by significant losses in recent months. From the standpoint of an Australian investor, today, we are down now about 14% from our peak achieved last year. So that officially puts us here in Australia into correction territory, which is defined as a decline of 10% or more. Some markets globally are in worse shape and are in bear market territory, which is defined as a 20% decline or more. So think about China, which is down more than 40% from its peak, or Japan or Europe, which are down more than 20% from their respective peaks. This is not a new phenomenon for us, though. Many of us in this room have significant experience coaching investors through difficult periods like this. In fact, this is the 11th bear market or correction here in Australia over the last 30 years. So on average, that means that we experience about one of these every 3 years. So we need to get used to this. We need to be practiced in the art of coaching investors through volatile times. Because when we do find ourselves in those volatile times, they do tend to persist for a little while, on average 276 days. Some corrections or bear markets are much shorter. Think about 2006 or 2011, where it was a short experience. In other cases, obviously much more protracted and painful. Think about the global financial crisis, which went on for a few years. This all makes it a very critical time for all of us and critical time for advice because, as we've heard, we can expect this environment to go on for a little bit longer. These structural challenges facing the world's global economies are not new, nor are they likely to go away anytime soon. But it's also a critical time for advice because we know that the nature of the advice proposition that we provide is changing somewhat. And Michael reflected upon some of these in his opening remarks. And in fact, this actually represents a significant opportunity because it is precisely during these periods of elevated volatility where we have the most significant opportunity to add value on behalf of our clients. So let me just talk through a bit of what that opportunity means to us today. And before I go into that too much deeper, I want to just reflect on last charts that Ken shared. And what we're looking at here is, again, an estimate of where we see forward-looking asset class returns over the course of the next 10 years. There's good news and there's bad news in this chart. The good news is that I'll focus on the growth-oriented portfolio. This is a 70-30 mix of stocks and bonds. That growth-oriented portfolio has a central tendency of around a 7% expectation for forward-looking returns over the course of the next 10 years. On an inflation-adjusted basis, and you've heard that inflation is probably expected to remain contained So on an inflation-adjusted basis, this means that inflation plus 4 or 5% and a 7% overall return is a reasonable likelihood for investors. That's the good news. The bad news is that from our experience and from a host of research and analysis that we and others have performed over the years, unfortunately, we know that many investors will not earn that 7%. They'll earn something closer to 4. And they'll earn something closer to 4 because of a general tendency to overconcentrate portfolios or trade too much or fail to rebalance, or in some cases abandon a well-formed plan during times of market stress or volatility like this. That 3% difference between what the market is offering and what all too often we tend to see investors earn is at Vanguard what we've referred to over the years as advisors alpha. The difference between what the market is offering and what an investor might earn on their own if left to their own devices without the help of professional advice and coaching. Increasingly, this sort of professional advice and coaching is of critical importance in our industry because we know that the nature of the value proposition of the advice that we provide is evolving. And think back to the client interactions that we had years ago, that all of you would have been having years and years ago. The focal point of our interactions and engagements with investors was often as an investment advisor or as an investment consultant, where the conversations were heavily oriented towards stock selection, or building a share portfolio, or timing the market, or conversations around fund selection, or manager selection, or tactical asset allocation. Very much a performance-oriented mindset and conversation. That is shifting. That is shifting in part because data, technology, model portfolios, ETFs are all, in many ways, commoditizing somewhat the portfolio construction and asset allocation process. So today and in the future, clearly, there's still going to be a very important role for portfolio construction and asset allocation and those key investment decisions that serve as the core of our relationships with our clients. But what's becoming of greater importance is the role as a behavioral coach, focusing on things like tax planning, embedding liquidity in portfolio, retirement strategies, income strategies. We're becoming much more holistic in terms of the planning engagements that we are undertaking with our clients. And there's data that reinforces that this transformation is taking place. This was from a survey that we conducted in partnership with a consultant here in Australia. And the good news here was that by and large, most of your clients were very happy with the services and guidance that they've been receiving. So we're starting off from a wonderful position of strength. But like anything else, there are areas of improvement. And these were some of the things that our investors noted were areas that they'd like to see greater focus going forward. And what's interesting about this list is not necessarily what's on the list. I think we probably all would have expected that better performance and lower fees and communications would have been things that our clients wanted more of. What was interesting and surprising to us about the survey data was the order of the survey data. What came first was lower fees, and then came better communications, more regular communications, simpler explanations. Better performance was on the list, but it was last. So this serves as reinforcement that those things that we can do to drive higher retention ratios, better referrals, and stronger net promoter scores among our investor bases are those things that we very much can control, like the nature, timing of the communications that we provide and the explanations that go along with it. So let's break down that 3%. So in order to unlock that 3% of advisors alpha, again, that difference between what the market might be offering and what all too often our investors might earn on their own, which represents the value that we can bring as advisors, we've broken it down at Vanguard into 6 different modules, 6 different components of the advice proposition that we can provide. The 6 components are listed here on the page, but where I really want to focus is on the behavioral aspect. Because what we found over the years is that the significant majority of that gap, that 3% gap, comes from behavioral tendencies and investors' biases and tendency to react to short-term noise in the markets. This is a particularly important area for us to develop in our toolkit as advisors, because the nature of consumer decision making is so different from the nature of investment decision making. What has helped us in the past as consumers making great decisions aren't always the same tendencies that help us as investors. So you think about how we make decisions as consumers. Let's step out of the world of investments for a moment. When we make purchase decisions as consumers, we're increasingly relying on data, technology, reviews, ratings. These are all things that many times, even now with a mobile device, allow us to make very quick, highly reliable decisions that give us great confidence that a purchase decision that we are making today will result in a good or a service that pleases us. A good or a service that comes with high performance and high quality, and really removes the role of luck in the purchase decision. You think about some of life's major purchases that most of us in this room would have been accustomed to making throughout the course of our adult lives. Selecting a university. U.S. News and World Report conducts an annual survey of the top universities. This report is done on an annual basis. What we tend to see from year to year is that there is a great deal of persistence at the top. The top schools 10 years ago have tended to be the same top schools today. Those same top schools are also typically the most expensive, so you get what you pay for. The same is true when we talk about cars. In the car space, Consumer Reports again does an annual survey broken down by different categories, whether it's truck, sedan, sports car, small car, economy, compact. Year in and year out, the top brands tend to persist. And again, you choose the category, there's typically quite a bit of persistence year in and year out, so you get what you pay for, again, based on the category that you select. Choosing a place to live, again, you get what you pay for, high degree of persistence year to year in terms of the top cities in livability surveys and rankings of local suburbs. These are all things that very much speed up and increase the reliability of our purchase decisions as consumers. It works with restaurants. So many of you in this room would travel to New York City. Certainly many of you in this room would be well informed about the top restaurants here in Melbourne as well. Restaurants in New York that earn the 3-star Michelin rating tend to keep it over time. The persistence exists, and you certainly get what you pay for. And the same is true in Melbourne. Once you earn that 3-star hat, the 3 hat, or the 2 hat, these restaurants have tended to maintain those ratings over time. And it works in the area of sport. Had I known when I got here 2 years ago that there was persistence within the Aussie Rules football ladder, I might have made a different selection than the Melbourne Demons that Michael talked me into on the beach on that night 2 years ago. And of course, in the world of tennis, there's only a handful of names that have really dominated the finals over the last 5 years. So this persistency and the notion that you get what you pay for is a difficult habit to break for us as advisors when those consumers walk into our offices looking for investment coaching and advice. So let's talk about that for a second. In the investment world, we don't see that persistence. We see almost a degree of randomness from year to year when we slice up equity market performance. In fact, there's even a strong tendency for performance to go from worst to first and sometimes back down to worst again. We tend not to see persistence in the managed fund space. This was a study that looked at 5-year fund performance, took the top performing funds for that 5-year period, measured them over the subsequent 5-year period. There were a few funds that stayed at the top, but there were just as many who fell towards the bottom or were closed altogether. And the notion in investments that you get what you pay for is not true. In the world of investments, you actually get what you don't pay for. So there's a strong relationship here between low cost and better results in the future. So this is a difference in decision making. This is a difference in framework that we as advisors need to be prepared to discuss and advise with our clients to unlock that 3% of advisors alpha that is there for us to add over time. But the challenge will be to overcome those behavioral biases. So what I'd like to do here is just talk through 5 examples, 5 very common examples of behavioral tendencies that we see from time to time that get in consumers' way when making very, very important investment decisions. The first is loss aversion. We can blame our ancestors for loss aversion. As humans, we have this innate tendency to favor our survival instincts. And it's been shown that we're about twice as sensitive to losses as we are to gains. And this manifests itself in 2 key ways in investment decision making with our portfolios. One, when markets sell off dramatically, as they've started to over the course of the last year, it can lead us to be tempted to abandon a plan and flee to safety. And obviously potentially lock in losses and fail to achieve the gains that we require in the future. The second key way that this can manifest itself in portfolios is through holding on to investments for too long. There are examples, again, of this that have been documented where if we select a share based on what felt like sound financial analysis or valuation at the time, but that has demonstrated that it is underperforming, we as investors often have a tendency to want to hold on for longer because we are reluctant to lock in that loss and admit that we might have been wrong. One way to combat this loss aversion tendency is to use remember when stories. Today, with markets going through the episode that they're going through now, a very helpful remember when story might be to reflect back upon the global financial crisis. At the depths of the global financial crisis, an investor with a 50-50 portfolio at one point would have been down close to 20%. No doubt, phones in all of your offices might have been ringing a bit more frequently with investors questioning how wise it was to stick with the plan. That was a key opportunity right there in February of 2009. Those of us who were able to caution our investors against the risk of abandoning that plan, who emphasize staying invested, rebalancing, staying the course, remaining patient, have earned years of their advisory fee based on the difference in performance results that investor would have achieved compared to abandoning the plan, going to cash, or going to bonds. You can see that the balanced portfolio has significantly outperformed. So remember those remember when stories. Overconfidence is a second key behavioral tendency that we have to overcome. You all know the examples. We all think that we are above average drivers. Everybody would claim that their children are above average students. Who wouldn't? In the world of investments, overconfidence has often been linked to too much trading activity, too little diversification, too much concentration in our highest conviction ideas. And over time, proof of overconfidence in investment markets has been linked to the general outperformance of index funds over actively managed funds over time, and the general tendency for passive benchmarks to perform as well or better on a risk-adjusted basis than many actively managed balanced strategies. So a way to temper overconfidence is to have very frank conversations with investors and our clients around what their expectations are, either in terms of asset class returns or our ability to have a high degree of conviction in those more active strategies or more aggressive strategies that we might favor. Self-control. In the world of investments, that apple that we might have to choose over that burger, that apple represents saving more today. That apple represents spending less today. Self-control refers to our tendency to favor immediate payoffs that might be smaller to a greater payoff somewhere down the road if we remain patient. So we might like that burger today, but our long-term financial health will be much better and will be much more improved if we save more or spend less today. This has been shown to exist in children as well. There's a famous study that was done at Chen's alma mater, Stanford University, that gave children the opportunity to select between a marshmallow today, right now, or wait 15 minutes and have a greater, larger treat. More marshmallows in 15 minutes. More chose the immediate payoff, the marshmallow in the moment. Subsequent studies showed that those children who were able to wait had higher test scores later in life and higher achievement levels later in life. And the same is absolutely true in the world of investments. Good example of this is some of our tendency to chase performance. We see this quite often with strong cash flows tending to go into those funds with the strongest recent performance. This was an analysis of the difference between actual fund returns in 4 different categories compared to the dollar-weighted returns in those same 4 categories. What we found is that the dollar-weighted returns tended to lag the actual fund returns in those categories, meaning that too often investors came into a fund after a period of wonderful performance and didn't experience that period of wonderful performance. They experienced, the settling down on the other side. We need to be cognizant as advisors, as behavioral coaches, of that tendency to chase and of all of our tendencies to favor that immediate gratification, that immediate payoff. Cognitive dissonance, this is this is the example where we will tend to disregard data or evidence or facts when it conflicts with our beliefs. We'll tend to rationalize those beliefs. In the world of investment, there's no shortage of conventional wisdom. There's a lot of conventional wisdom, a lot of beliefs that would purport to be able to pick better performance in the future or pick winners based on which funds have been the better performers in the past, or which funds are the smallest and most nimble, or the biggest and most proven, or the funds that are the most concentrated or have the highest degree of conviction. The data and the evidence and the research have not demonstrated that conventional wisdom is necessarily supported with better future performance. The only thing that the data and the evidence have consistently concluded leads to better performance in the future is low cost. The way to combat this with our investors when we encounter it is to reinforce the data, reinforce the research, reinforce the evidence that we've discovered over the years. The last behavioral bias that we see quite a bit in this industry in particular is groupthink. This is our tendency to tend to make decisions that are very consistent or very much reflect the views of others in our practice or on our investment committee or within our industry. In its worst forms, this can mean even seeking out data or research or evidence that supports our views. Obviously, a great way to combat this is by ensuring that we have a devil's advocate within our practice or within our investment committee to challenge our views or challenge our thinking. And there are many, many examples of this in the investment world. And economic and market forecasts is a prime example. Many of us, myself included, have email boxes that are full of annual market outlooks around the turn of the year. And all too often, those market and economic outlooks are not significantly differentiated from one another. And that can come from the tendency for groupthink and the tendency to be unwilling to have a very different point of view or a different forecast for fear of being wrong. Another place that we have seen this when it comes to portfolios is in the area of fixed interest. Think back over the course of the last year and a half, there's sort of been one prevailing view in the marketplace around the direction of interest rates, and that was oftentimes that interest rates were no doubt eventually going to be headed higher, and that meant bad things for our bond portfolios, and then as a result, bonds tended to be underrepresented in many investor portfolios. What's happened over the course of the last year, and this was especially evident in the month of January, was that in a very volatile and difficult, challenging market for riskier assets, defensive positions held up well and provided significant downside protection. And that was the case with fixed interest. So the downside of groupthink can be that we have other ideas that are underrepresented in our portfolios that may benefit investors. So again, these are the 5 biases that we've discussed. The common element in terms of coaching and advising investors when we recognize these 5 biases in portfolios is education and communication, again, reinforcing those same things that investors have told us that they are happy to have more of when it comes to the engagements that they have with us. And this is where I'll wrap up my comments. So we've talked about how we would expect the market environment to remain challenging and somewhat volatile. This is not a new phenomenon, nor is it one that we would expect to go away anytime soon, given some of the longer-term structural forces that Chen has described are very much at work today. And against the backdrop of an evolving value proposition of advice, and particularly against the backdrop of that potentially more volatile market environment, there's a significant opportunity for us to add value through that behavioral coaching over time by recognizing and spotting and treating some of these tendencies that I've shared with you today.
I just thought I'd give you a quick update on our ETFs. This is looking at the market. Over the last few years, the ETF market has grown substantially. On this chart, we've got in the blue bars just the assets under management, and you can see that it's just approaching 20 billion, or it's now just over 20 billion. And in the red, you've got the number of ETFs on the market with over 124. We expect the ETF market to continue to increase dramatically over the next few years. And increasingly, our conversations with advisors and brokers is about ETFs. So we think that they are a really good vehicle for your clients to use. Obviously, we've still got our managed funds, which we think play an important role in portfolios as well. But we do have the ETFs. And I just wanted to bring to your attention, late last year, amongst all the Christmas festivities, you probably received an email regarding 4 new ETFs we launched. 2 regional equity ETFs, a European one and an Asia ex-Japan. And then, more importantly, we launched 2 fixed income international ETFs, which really rounded off our stable of ETFs. So now you can actually put a full model portfolio of ETFs together using our international fixed income with the other ETFs on the market. All very low price, so we believe this is a great addition to the market. And we've actually put together some model portfolios using our diversified funds asset allocation. And you can see on the screen, we've got the 4 from conservative to high growth, the income and growth assets. We've got far more details that our BDMs and BDCs can show you. But what you can see is our high growth, if you use our ETFs, the combined cost is 14 basis points. That's very, very low. For our growth, it's 16, for our balance, it's 18. So you can put together a very low cost portfolio using our ETFs. That's it for today. I'd like to thank you for all coming along. It's been a great day. Hopefully you've learned a lot from both the sessions. As I said, we'll be around for a little while if you do have any questions. On behalf of Marcus Wallace and the Southern Region team, I'd like to thank you for your continued support and hope you have a fantastic day. Thank you very much.